Hello, it's Robert Miner with Dynamic Traders Group with this week's DT Trade Strategies for the week beginning September 19th for our Twitter and YouTube followers. This is where we spend a few minutes taking a look at a couple of markets with potential trade setups, as well as hopefully give you some education that you can use with any market and any time frame. At Dynamic Traders, with our DT reports and with our DT software and our educational material, the objective is to teach you how to trade, not how to forecast. Two completely different jobs. So trading involves trading strategies from entry to exit. Forecasting is for other folks. So, okay, let's take a look at two or three markets here briefly. We'll follow up on a couple we've looked at over the last week or two, and maybe look at one or two new ones as well that may have a good trade setup coming up this week. We're going to take a brief look at gold. We look at that every week or two. It's one of my favorite markets to trade. The first trading report that I produced was in the mid-1980s. What's that, over 35 years ago. And it was called the Precious Metals Timing Report, where I just looked at gold, silver, and platinum. Well, today we have gold, silver, and the GDX in all of our DT reports. And it's one of my favorite markets to trade, as I said, because it does great patterns and makes great reversals at projected time and price targets. So here we've got the weekly data, and the weekly momentum's made a dual look-back bullish reversal a couple weeks ago. That typically either coincides with a price low or at least warns us that the downside is pretty limited before we complete a weekly low. So that's pretty critical here, because this is a corrective type of pattern. So when this correction is complete, more than likely we're going to continue the bull trend to a new high. That's why we want to focus all of our energies on identifying the end of the correction. So is it complete yet? Given that we've made dual look-back momentum bull reversals, maybe, maybe not. This is where it's real important we go down at least one time frame and we identify a specific trade strategy that will confirm that we've completed a low. So here's what we've been looking at, and I've mentioned this several times in the past few weeks. And nothing's happened yet. We haven't got any triggers yet in gold because it's been sideways for over a month, literally sideways, and basically in a trading range. So what we're looking at is the relationship between price and the momentum cycles and the price cycles. So we have our momentum is reaching overbought, almost at the overbought range, meaning we're pretty close to a momentum high, which means we should be pretty close to a price high as well if it's not complete last Wednesday. So if we make a bear reversal on the daily momentum and we have not closed above 1978.90, then more than likely we're going to continue sideways, potentially to a new low. The point would be is that we're not in a position to consider a long trade yet, and even if in the next couple of trading days we were to close above 1978.90, why is that important? That's the last closing high. Closes are very important when trading and understanding the position of the market. What if we did close above 1978.90 before making a bear reversal in the daily momentum? Would that be a swing trade? Go long at new highs? Well, from my point of view, it would not be, because we'd be near a daily momentum cycle high and a bear reversal, meaning there would probably be little follow through following that breakout if it should be made. And again, not forecasting that. So we want to wait for the next daily momentum bull reversal and see where price is when that's made. Certainly, if price has not closed below 1934.30 when that's made, then that will be the ideal dual time frame, daily, weekly momentum setups to complete this trading range. So that's what we're looking at for the days ahead. Now, we could be several days away easily into the latter part of this coming week or even in the following week before we make that next full cycle in the daily momentum and know whether we got a good setup or not. But this is where it's really important, and that whether you're looking at Elliott wave, you're looking at whatever technical system you're looking at, is if you believe a market's in a position, in this case, to have completed a corrective low, which we'd call a wave 4 low, then you have to identify what specifically can the market do to set you up for a high probability trade. So we've identified what we're going to look at in gold over the next few days. We're not quite there yet, but we're getting pretty close. And we still have the possibility, if we make this daily momentum bear reversal without having closed above 1978.90, of continuing on to a new low before we finish this, what I'm considering is a probable wave 4 correction. Well, let's take a bit of a detailed look at the stock indexes, particularly with the SPX. Always look at the SPX first, the cash index, because that represents the broad market, at least of the big cap stocks. And all of the indexes tend to reverse and trend in the same direction. It's just that at different times, one's stronger or weaker than the other, that sort of thing. But here's the SPX. And as of a couple of weeks ago, we were about 3 or 4 weeks ago, actually, we were on alert to look for signals of when a weekly high might be complete. And 3 weeks ago, the week ending September 4th, is we made an outside bearish reversal in the SPX. And that itself, with an outside bear reversal, is a pretty significant reversal signal. And at the same time, we made a dual look back bearish reversal in the weekly momentum. So when the two of those are made together, pretty strong signal that we've completed at least a weekly high, and we're going to be sideways to down for 3 or 4 weeks. So the next thing we do is we want to identify a specific entry strategy if we weren't already short in this case, and we'll go over that in a minute. But while we're on the weekly chart, we want to also identify what can the market do to indicate it's making more than just a minor correction, like one of these. These were basically just 2 week or so corrections. Well, the first thing it can do, it can overbalance in price and time. What's that? That's when if the S&P were to make a decline greater in time and price than any of the corrections since the March low, that would indicate that it's making a higher time frame correction than just these 2 or 3 weeks. W.D. Gann called that an overbalance of time and price, and I can tell you it's really useful on all time frames. When you make an overbalance of time and price after particularly an extended trend like this, it's a really good signal that you're making something more than just a 2 or 3 week correction. So we did that this past week. We made an overbalance of price and time. We actually closed below the 100% alternate price projection of this decline back in June, which was the largest decline, even though it wasn't much of one, was it? But it's the largest one since the March low. So more than likely, we're making more than just a 3 or 4 week correction. So we should be sideways to down, and more than likely into early November, if not later. And this is a possibility it's even a much higher time frame top, but we'll discuss that in the future in our DT reports, which I hope you'll take a 1-month trial subscription to. But anyway, the immediate position is the weekly momentums are bearish. They're not oversold. That alone tells us we probably have another 2 or 3 weeks of this immediate decline, not necessarily for the higher time frame decline, but what we call a weekly trend. So we probably have more to go on the downside. Here's our daily data. And what we're looking at as of the end of last week was any sort of typical correction, in this case a wave 2 or B correction, and that if a market got into position to complete a wave 2 or B correction, then our whole focus is going to be on identifying a short trade for a probable continuation to a new low. Well, we made that setup last Wednesday. Wednesday here was an outside bear reversal day. However, we had not made a daily momentum bear reversal. So on our Wednesday video, what I told our subscribers is I said, I'm going to be focused on identifying a short trade. However, we haven't made that bear reversal yet in the daily momentum, and we really need to make that to confirm this price reversal, because usually we weren't even overbought, or we just barely reached overbought then, and usually we're well into overbought before we complete a correction. Well, the next day, of course, we made a lower close. We made the bear reversal, and that was uh, an entry on the close for lightly leveraged or unleveraged trades, like for instance, in ETFs. It'd be too big of a protective stop for highly leveraged futures, at least for any kind of sizable position. But there's always a vehicle for whatever signal you get. So if the stop needs to be quite a ways away, just consider bear market ETFs. There's unleveraged bear market ETFs, there's 2 times and 3 times leverage. Great vehicles for relatively short-term trades on a market with minimal leverage, minimal capital exposure. So we had the signal, we had the confirmation the next day, and I actually did a special tutorial for our subscribers today. We do trade strategy tutorials about every week on the setup during the day on Friday, yesterday. That was a real low capital exposure setup on an intraday correction to get short, and it panned out to work out pretty good, at least so far. I've already, as I showed in the tutorial, been able to adjust the stop to break even, which is very good. And we have closed below the closing lows of the past couple of weeks. That's a bearish continuation signal. Our daily momentums are bearish and not oversold. That indicates we got 2 or 3 more days, probably at least, sideways to down. So for the immediate term, probably got 2 or 3 more days sideways to down. But if we make any corrective or any rallies here in the coming week, they should be just 3 or 4 day minor corrective rallies, excuse me, within a weekly bear trend, which has 2 or 3 weeks to go, more than likely at least. And it's a possibility. It's a much higher time frame decline than just a few weeks. So we'll be addressing that as the market progresses. And just one other piece of information here. This is 3151 is the 100% alternate price projection of what I have labeled as a wave 1 or A from what I got labeled as a wave 2 or B high. So more than likely this is a 1 or A and a 2 or B. If that's the case, a typical target for just a wave C would be around 3151, the 100% alternate price projection of the wave 1 or A. So even if we're making just a typical correction over the next couple of weeks, more than likely we would reach around 3151. However, we're not speculating or forecasting that. We're just saying that we want to be aware of it. And so if the market continues lower and if it reaches around 3151, we want to be aware that that may be a significant price area, and we want to look at the pattern position, other time frames of price around there. Well, that's it for today. Robert Miner here. I hope you check out our DT reports, where every day we keep up to date on most of the major financial markets as well as the dollar index and the euro. Over and out for now.